One of the most dangerous games you can play in financial investing is trying to predict the future. I'd say you could probably be wrong 9 out of 10 times. Well, I'm in the oil and gas industry. I've been doing this since 1985, and I can assure you there's been black swan events that happen seemingly every 6 months. It can be changed in economy. It can be caused by geopolitical events. You name it, there's 1,000 reasons why commodities like oil and gas will vary in price from time to time, month to month, year to year. Right now, here we are in the middle of 2 wars that are raging. We have the Russian war with Ukraine. We have the US and Israel at war with Iran. We have, for the first time ever in my 41-year career, we have a cataclysmic shortage of supply caused by a chokehold in the Strait of Hormuz. We don't know when that chokehold is going to stop. We don't know the actual residual effects. I don't think anyone has ever figured out what this really looks like in terms of logistics, supply, and what we can do to solve the problem, if it can be solved at all. The downstream effect, customers can't get the oil they want. Refineries can't get the product they need. The raw mixed material, the downstream byprocessed and refined product are becoming short supply. Prices are escalating. Individual consumers, whether it be countries or manufacturers, deciding how they can go to alternative energy as a short-term solution to a shortage of raw crude oil being produced around the globe and delivered around the globe. With all that being said, you have to make a decision. You have to decide where do you think the ball is going to bounce. If you're truly in the business of oil and gas in any regard, you're going to have to make a decision based on the facts you have today where you think that ball is going to bounce. So here we are. We're in the coming up middle part of May. Oil's trading at $102 a barrel today. 8 or 9 days ago, we were down to $84 a barrel. 2 months ago, we were at $119 a barrel. That's a broad spread over 60 or 90 days. Every single message that comes out of the White House, every message that comes out of the Iranians or the Middle Eastern media, every single tidbit, a crumb of information seems to push up or down the price of oil. So the question I get a lot from our partners, and the question I get a lot from my own staff is, where do we see the price of oil looking like by the end of 2026? That's 7 months away. And why is that important? Because assets you buy today, wells that you drill today, wells that you frack and complete today are going to be coming online in 60, 90, and 120 days. And so the cost of those services, the cost of drilling, the cost of fracking, the cost of equipment today is based on assumptions you have to make when those wells come online. You've got all kinds of different investment capital between bank loans or investors that are saying, we acquired these assets last year. We had a pricing model based on NYMEX. We have an expectation of what the wells are going to produce and what the income is going to generate. And now all of a sudden we have this outlier, which is a $30, $40, $50 increase in the price of crude oil. Is that just a short-term window? Is this more of a sustainable upward mobility in the price of commodities? Again, I'm not the smartest guy in the room. Don't claim to be. But I am a guy that since 1985 has studied this market very, very well. And here's what I can tell you. Like a light switch, if somehow President Trump gets some kind of a peaceful accord with whoever's in charge of Iran that actually is in charge and not just the leader for the day, there's going to be a big reversal in the price of oil only because the traders and everyone else feels like, okay, this chaos, this logistical nightmare has come to an end. So you could see oil pull back from $102 a day, and it might pull back like it did 2 weeks ago, a week and a half ago, $84 a barrel. Is it likely to go back down to $56 a barrel like we had in January? Is it likely to go back to $66 a barrel, what it was trading at just before the war broke out? I'm in the camp that says not going to happen. Not for 6 to 12 months minimum. Not going to happen. I'm looking at a new base price north of $75 a barrel, even if everything was resolved today, because the amount of logistical chaos and the discourse between wellhead production, carriers, waterborne vessels, refineries, equipment, plants, disruption across the globe, it's going to take 6 to 12 months to have this ironed out. That to me says $75 is probably going to be the normalized basement or floor for where crude oil prices are going to be based on West Texas Intermediate pricing. But if I look at it from a really practical point of view, it's going to be much higher than that. And that's because when you lose 1 to 1.5 million barrels of oil that have been plucked out of the supply side, and you don't have the exploration side replacing that 1.5 billion barrels, you now have to work twice as hard, or at least significantly much more robust in terms of output, not only to maintain that 100+ million barrels a day that the globe needed before the war started and they'll need after the war is resolved, but you also have massive growth in terms of artificial intelligence around the globe, manufacturing, stimulation. It's all going to be there. So the question is, how do you get back to normal, make that 100 million barrels plus a day, and go back and recover that 1 to 1.4 billion barrels that you need to put back into storage tanks, facilities, refineries, in the storage SPR, Strategic Petroleum Reserves, and G7's Strategic Reserves? How do you do that? Well, you're going to have to encourage exploration. You're going to have to encourage more wells, more drilling, different parts of the world. Let's face it, folks, you're about to find out the actual economic break-even around the globe, because there's certain parts of the globe that are saying, hey, we can now afford to go drill now that it's $100 a barrel. Whenever it was $55 or $60 a barrel, you had all these areas around the globe that had no activity, very little drilling, very little exploration. It's because the governments owned it. That was their own concession, their own mineral resource they were developing, so they pretty much owned 100% of what was being pulled out of the ground. But they still couldn't make very good economic sense at sub-$60 prices. You get a $100 price per barrel of oil or higher, now there's parts of the globe that not only make sense, it makes really, really good sense. And if they can go drill and put wells online right now with escalated commodity prices, they can make up a lot of economic value, billions of dollars made over the next 6 to 12 to 18 months, and they can do it very, very quickly in a robust market like this. In fact, those who produce oil and gas around the world are saying, we don't want peace. We don't want Iran to get along. We don't want President Trump to come up with a peaceful accord. We want 6 months, 12 months, 24 months of super high oil prices so we can make up for the last 4 to 6 years of getting decimated in terms of lack of capital, low oil prices, and lower revenue for their countries. Some countries are going to win, some countries are going to lose. So for my own prediction, I truly believe that by the time we get to December 31st of this year, we're going to be north of $95 a barrel. I believe this war will not be over in the next 90 to 180 days. I believe even if it's over, the true economic impact of lack of supply, growing demand, trying to refill all those different storage facilities and making up that lost, what I call in the pipeline, in the tank supply that has been completely consumed, I feel like we're in a situation that there's nowhere to go but probably $95 a barrel or higher. Will we have this automatic traders reduction? Of course, it's natural. Traders make money by arbitrage. But the physical barrels that are missing, the physical barrels that are available, unless there's some kind of miraculous increase in Guyana, or they bring Venezuela up to 3 or 4 million barrels a day, or we add some other place around the world, you're looking at a consistent 10 to 15 million barrels a day that have been disrupted. That's going to take a while to refill. That tells me short term, the next 7 months, we'll bounce somewhere between $84 a barrel like 2 weeks ago based on some announcement that has no real credible backing to it. The president comes out, makes a statement to drive prices down because the economy is going to get its tail kicked if oil prices stay where they're at. He's trying to get everybody to hurry up and drop oil prices, which is not going to happen. And on the flip side is, you're hoping it doesn't go to $125 to $150 a barrel, because now you're talking about true demand destruction. So the soft spot for me is between $85 and $95 a barrel, but I truly believe this is not a situation that's going to be resolved. And as a result, I'm looking at closing day this year, the last trading day, West Texas Intermediate prices of $95 a barrel. One man, one opinion.